All right, you ready for this segue? Just like the weather is clearing up, the financial picture also seems to be clearing up as well. And with us now is Sloy. You're a certified financial planner. You're with Sloy, Dahl and Holst right here in Portland.
That's right.
You were here about a month ago, a little over a month ago, and you were pretty optimistic about the markets at that point. And since you were here last, the markets have moved higher about 1,000 points or so. What are you expecting between now and the end of the year? We've got a little over a month and a half left.
Well, I think we're headed higher. As I said when I was here in October, about a third of all managers have missed this move, and so consequently they're having to chase the S&P for year-end results. The S&P year-to-date right now is up 20%. So a lot of these managers have been sitting in cash, and now that the September and October is gone, they feel pressure to perform, and they're going to have to post a number in January. So we're moving higher.
How much higher do you think we're going to get?
I think we could put another 5 to 1,000 points on the S&P by year end, or on the Dow, and by June we could see 12,000 to 13,000 Dow. We're still 4,000 points though below the October 2007 highs. So we've moved 4,000. We're still 4,000 points below, and that's why I think we're headed higher.
There's still some room to go there.
There's still some room.
One of the concerns that people had in a very real and tangible way over this past year was that they're looking at their 401k statements come in, and you just see those numbers dip and dip and dip, and you think, really, this is my retirement. Should I be continuing to invest this way? And many people have pulled away from investing in their 401ks as they had in the past because they don't see it as a safe bet. What would you say about 401k investment in particular?
Well, I think it's interesting. You can't touch this money till age 59 and a half without a penalty. A lot of people decided they were going to stop their contributions and they were going to wait for the market to get better. You cannot time the market. The market from March 9th to now has moved 60%. And so consequently, what a person should do is they should be doubling up on their contributions during the period when the market's going down, because you're buying all those share prices much cheaper.
Right.
And if you miss this move, you just compounded all the problems that happened in 2008. So my advice would be stay invested, check your allocations. Often people don't have any idea how their money's allocated in their plan, and make sure you're not sitting in fixed income, and look to make sure it's appropriately invested.
And I've got to ask you about one other thing that we had up on the screen a minute ago, the rule of 72. What is that? The
rule of 72, whatever you divide into 72 is how long it should take your money to double. So if you're earning 10%, it'd take your money 7.2 years to double. And so people should look at the long-term aspects of the market, stay invested, and stay calm.
Okay. Great advice from you, Sloy. Thank you so much for being here.